Ismail Vaslava, Grand Capital financial analyst. Today we are going to start our review with the euro that rose sharply against the dollar on Tuesday, boosted by relief among investors that Italy managed to sell government bonds to the market even though it was forced to pay record high auction yields. Traders said speculation of good demand at the auction started to drive the euro higher ahead of the results, while buying by hedge funds also drove the single currency higher. The euro was last up to 0.6% on the day at 1.3391. It hit a session high of 1.3442 after breaking through reported stop-loss orders at 1.34 and 1.3415. Traders cited further stops building around 1.345 knot and 1.346 knot. Italy sold 7.5 billion euros of 3 and 10-year government bonds, close to the upper end of its target range. Analysts said that although the yield of the new 3-year Italian government bond soared to almost 8%, a level seen as unsustainable is the long term. Some market players had been concerned Italy would struggle to shift the bonds at all after weak demand at a German auction last week. Deutsche Bank also expected liquidity to deteriorate into year and forecast the euro to be around 1.25 by the middle of 2012. The rally helped the single currency consolidate the previous day's gains. When the euro rose on cautious optimism, European policymakers could make progress in tackling the debt crisis this week. Eurozone finance ministers meet later on Tuesday to approve detailed arrangements for scalping up the EFSF rescue fund to help prevent congestion in bond market. They are also expected to release a vital aid lifeline to Greece. Germany and France reportedly aim to outline proposals for a fiscal union before a European Union summit on December 9th, which a growing number of investors see as perhaps the last chance to avert a breakdown of the single currency area. But strategists warned that the euro remained vulnerable to renewed selling unless investors see concrete action, given they have disappointed by policymakers in the past. Some traders said markets were simply looking for an excuse to cut bearish positions on the euro and commodity currencies after going short risk last week. The euro showed little reaction to a report on French newspaper La Tribune's website saying Standard & Poor's could change the outlook for France's AAA rating to negative within the next 10 days. There was also little reaction to news that Fitch and Cut has the United States credit outlook to negative, although it expected to move on the actual rating until late 2013. Perceived riskier currencies rallied in line with the euro and equities following the Italian auction. The Australian dollar climbed nearly 2% to recession high of US dollar 1.0078, with some resistance seen around 21st and 55th day, moving averages around US dollar 1.0096 and 1.0098. And broad dollar selling, the greenback reversed dollar gains against the yen to fall 0.3% to 77.69 yen, while the euro managed to extend gains versus the Japanese currency, last trading up 0.4% at 104.121 yen. The dollar index fell 0.8% to 78.657. Data from the U.S. Commodity Futures Trading Commission shows currency speculations raised their bets in favor of the US dollar to the highest level in the 5 weeks in the week ended November 22nd. The same data also showed speculators increased their bets against the euro from a week earlier, suggesting that short covering may land the euro support. You have watched Daily Market Review with me, Ismail Vaslava. See further details on our site grandcapital.net. I'm wishing you good trade. See you later.